Everyone thinks the worst stock market crash happened during the Great Depression. It didn't, and the truth is stranger than fiction. It took less than 6 hours. By the time the closing bell rang, Wall Street had suffered the worst one-day percentage collapse in its history. No war had started. No major natural disaster had struck. There was no single event that explained the panic. Yet, traders shouted across the exchange floor. Phones rang without stopping, and ticker machines fell so far behind that many investors were making decisions using outdated prices. Some simply stood frozen, watching years of savings disappear faster than they thought possible. By the end of the day, the answer would shock the world, but to understand why it happened, you have to rewind a few months. For most of the 1980s, investing felt easy. The economy was growing, inflation had eased, companies were making money, and stock prices kept climbing. With every new record, confidence grew stronger. Many investors stopped asking whether prices were too high. Instead, they asked how much higher they could go. Behind the optimism, however, small cracks were spreading. Interest rates were rising, stocks looked expensive. Markets had become increasingly dependent on confidence, and confidence is easier to lose than it is to build. Then, during the week before October 19th, prices began slipping. Most people saw it as another routine pullback. It wasn't. It was the beginning of a chain reaction that nobody fully understood. When trading opened on Monday morning, selling accelerated almost immediately. Then, something designed to protect investors made everything worse. Large institutions relied on computer programs that automatically sold stocks as prices fell. The strategy, called portfolio insurance, was supposed to limit losses. Instead, it multiplied them. Every wave of selling pushed prices lower. Lower prices triggered more automatic selling. Within hours, fear had become a self-feeding machine. Buyers disappeared. The Dow Jones Industrial Average plunged 22.6%, still the largest one-day percentage drop in its history. Roughly $500 billion in market value vanished before the closing bell, more than $1 trillion in today's dollars. The panic didn't stop at Wall Street. It spread across Europe, Asia, and Australia before the day was over. Many believed another Great Depression had begun. Surprisingly, it hadn't. Within hours, the Federal Reserve announced it was ready to provide banks with the liquidity they needed to keep the financial system functioning. The message was simple: the financial system would not be allowed to fail. Confidence didn't return overnight, but panic slowly gave way to stability. Banks continued lending, businesses kept operating, investors regained trust. Within 2 years, the market had recovered. Black Monday permanently changed the way markets operate. Regulators introduced circuit breakers to pause trading during extreme declines, giving investors time to think instead of react. Risk controls improved. Computerized trading became more closely monitored. But the biggest lesson wasn't about technology. It was about people. Markets don't crash because numbers become afraid. People do. When enough investors believe everyone else is heading for the exit, fear spreads faster than logic ever can. On October 19, 1987, Wall Street didn't just lose nearly a quarter of its value in a single day. It lost confidence. And history has shown, again and again, that confidence takes years to build, but sometimes only hours to disappear. And that's why